Thanks for joining. This is Ross Bramwell from Homrich Berg. In this video, we'll discuss what we believe is the market's shifting focus from inflation to earnings in 2023. Earlier this month, December's year-over-year headline Consumer Price Index, or CPI, was reported to be 6.5%, a decrease from November's 7.1%. It also marked the sixth consecutive monthly decline since June's peak of 9.1%. CPI is often reported as a year-over-year number. However, when markets and the Fed are scrutinizing every data point related to inflation to determine when the Fed may pause or if the Fed will lead us into recession, looking at shorter trends may give us a better idea of what is happening today in the U.S. economy. For instance, in the report released earlier this month, the month-over-month inflation change was actually a negative 0.1%, the first negative monthly change we have had since May 2020. If we kept this shorter trend of month-over-month change of negative 0.1% for the next 3 months for January, February, March, CPI would decline to almost 3% in March. And in the second quarter, we would reach the Fed's target of around 2%. We have often remarked that we believe inflation will need to be below the Fed funds rate in order for the Fed to pause, as that has been the historic precedent. If the current trend were to hold, that could likely occur by sometime this spring. In this chart, the main takeaway is that inflation in the short term is declining, and rather quickly for most categories. The main holdout is shelter, which is shown here in the tan line and is really the only line which is somewhat on an upward trend on the right side. Shelter costs are calculated using a 12-month weighted average, so we know CPI is using lagged data and is not necessarily a good indicator of current pricing pressures, whether upward or downward for shelter. All other groups of services and goods are generally trending downward, which is a welcome relief for markets and consumers. So inflation was the story of 2022, and it drove markets, stocks and bonds, and the Fed last year. This year, we expect markets and the Fed to move past inflation and that they will focus on employment, which the Fed still believes the job market is too tight, and also corporate earnings. The Fed's Goldilocks scenario is if the Fed can get inflation back down closer to its target without unemployment rising significantly, a feat that has not been achieved historically. However, even if that can be achieved, the markets are still left wondering what will happen to corporate earnings as consumers feel the pain of the Fed continuing to tighten financial conditions. Earnings growth estimates for 2023 continue to decline. Last summer, they started around 10% and have now declined to low single digits. We will still watch the monthly inflation data, but to indicate where markets may go this year, we will be watching closer their earnings guidance as companies report this month and next. Thanks for watching. If you would like to discuss further or have any questions, please reach out to a member of your service team. Thanks again.